Welcome to the Deep Dive, the show that tries to cut through all that noise, the daily news, the market headlines. It's just relentless, and it's so easy to get swept up in the fear or maybe just the confusion of it all. You see a headline, and your gut reaction might be, well, panic or just feeling totally overwhelmed. But what if there's always a deeper story? What if the real drivers, the things really shaping our financial world, are kind of hidden beneath the surface? That's our mission today, really. We want to go beyond that surface stuff, uncover the surprising insights, the facts that often get missed, but, truly shape things. Okay, let's unpack this.
Absolutely. And our guide for this journey today, it's a fantastic resource, a decade's worth of market commentaries from investment strategist Bob Froehlich. Now, he's really known for his, let's call it, Main Street perspective, and maybe more importantly, his knack for challenging what everyone thinks they know, common assumptions. So our goal today is simple. Give you, the listener, a fresh lens, a new way to look at the economy and market developments, give you knowledge that goes, well, a bit deeper than the typical news bite.
That sounds like exactly what we need right now. It feels like we're constantly fed a certain story about the economy, but you're saying Froelich often found that, well, that story just missed the mark.
Oh, definitely. He consistently challenged conventional wisdom.
So where should we start? Which myths did he tackle first?
Let's start with a really persistent one. He called it the jobless recovery narrative. You hear that a lot during economic upturns.
Around the time, yeah.
But Froelich consistently pointed out that those initial payroll numbers, they actually understate the real job creation, often by quite a bit.
Really? Understate?
Yeah. He actually noted they could miss as many as like 100,000 jobs in those first counts.
Wow. Okay.
And then, later on, the revised data, it almost always paints a much stronger picture. More jobs. The key thing to get is the employment cycle. It goes economic growth first, then profit growth, then businesses start spending more, and finally, employment growth follows.
Ah, okay. So jobs are the last piece of the puzzle, not the first.
Exactly.
Yeah.
The last domino to fall. So if you're only looking at those initial job numbers, you're usually, well, you're looking backwards, kind of. You're behind the curve.
That's a really powerful reframing because, yeah, the immediate headlines always sound so much bleaker. It's not that jobs aren't there, just the count is lagging. But speaking of jobs, outsourcing, that used to be such a hot button issue, always framed as just, killing domestic jobs. Did Froelich challenge that too?
He absolutely did. And it's a perfect example of how easy it is to jump to conclusions based on, well, fear or just incomplete information.
Yeah.
He actually referenced a specific Wall Street Journal piece, March 16, 2004. It showed how outsourcing, in some cases, actually ended up creating more jobs right here in the United States.
Creating jobs? How does that even work? That's totally counterintuitive.
It is, and it just highlights that these economic forces are way more complex than the simple sort of one-sided story we often get fed. It's not always straightforward.
Okay, that really does go against the grain. Makes me wonder about other economic bogeymen, I guess, like inflation. Economists are always flipping between worrying about it and not worrying about it. What was Froelich seeing there?
Right. He recalled a time when lots of economists suddenly flipped. They went from predicting deflation, falling prices, to suddenly fearing runaway inflation. But his chief economist, Maureen Allen, she made this incredibly insightful call way back in 1998. She basically said the new risks would be deflationary, not inflationary. And she was right.
So what was keeping inflation down then, according to Froelich?
He argued there were two really powerful factors that people were underestimating. One was the global economy, just more competition from everywhere, and the other was surging productivity, making things cheaper to produce. He also mentioned increased competition within the Eurozone itself after the euro came in. That also helped keep a lid on prices across Europe.
Interesting.
So yeah, while many were, bracing for everything to get more expensive, these big structural forces were actually pushing prices down.
So the big inflation scare back then was mostly misplaced because of these deeper global trends.
Got it. What about gold then? Isn't that supposed to be the ultimate sign of inflation coming?
Ah, yeah, the gold inflation idea. That's another common assumption he really questioned.
Okay.
He argued that, well, a rise in gold prices isn't necessarily about inflation. Not always. He pointed to this supply-driven rally back in 1999. What happened was the European Central Bank and 14 other nations agreed not to sell any more gold for 5 years.
Ah, So less supply.
Exactly. Less supply pushes the price up. Right. But it wasn't necessarily because demand was soaring due to inflation fears. It was a supply thing. He suggested looking at broader measures instead, like the CRB commodity index that tracks a whole basket of raw materials. That gives you a much better picture of actual price pressures across the board, rather than just focusing on gold, which can be misleading sometimes. Right. Don't get tunnel vision on just one indicator. Makes sense. And what about the whole new economy hype? I definitely remember that. The internet was going to change everything, make old businesses obsolete. How did Froehlich view that?
Yeah, he saw that as a classic misconception. He was very clear. The internet is basically a tool, a very powerful tool, sure, but still a tool. And the real winners, often they were the so-called old economy companies that figured out how to use that tool effectively.
Like who?
Well, he mentioned Southwest Airlines, for example. They
Yeah.
used the web for bookings, dramatically cutting costs and boosting business,
Mm.
or the big three automakers using the internet to streamline, connect with customers better. He used this great analogy, like our daily lives still depend totally on old economy stuff. You wake up under a blanket, you shave with a razor, you drive a car.
Mm.
These are old economy products, right?
Hmm.
The new economy, he argued, couldn't really take off without the old economy actually fueling the tech revolution. It wasn't replacement, it was synergy, integration.
That makes so much sense when you put it that way. Integration, not destruction. Okay, one last myth then. Government spending and the deficit. We hear about it constantly. Usually sounds like, the sky is falling. How did Froehlich reframe that?
He definitely pushed back hard against the alarmist tone you often hear. His approach was simple. Look at the budget deficit as a percentage of GDP.
Okay, relative to the size of the whole economy.
Exactly. Because that tells you about the economy's ability to actually handle it. He put it in context. In 2000, the U.S. deficit was below 0.5% of GDP. Tiny. Even with the Bush tax cuts later, it was projected to be around 2% of GDP.
And how does that compare historically or internationally?
We'll compare that 2% to, say, the requirement for countries wanting to join the Eurozone. Their deficit had to be 3% of GDP or less. And historically, during World War II in 1943, the U.S. deficit hit, get this, 31.1% of GDP.
Whoa. Okay, that is context.
Right. So from that broader perspective, Froehlich argued it just wasn't the five-alarm fire that many were making it out to be. Not ideal, maybe, but not a crisis.
Talk about shifting your perspective. Wow, it really shows how vital context is when you're looking at any economic number. Okay, let's shift gears now. Let's talk about the Federal Reserve, this, seemingly independent body that has such a huge impact on all our financial lives. What do people often miss about the Fed?
That's a really important question because, yeah, the Fed's structure, how it operates, it's often misunderstood. First off, the Federal Reserve is designed to be independent. It's not owned by anyone, and it's not a private company trying to make a profit. That's key. It's run by a board of governors. They get appointed for these long 14-year terms, so they span different presidents, different Congresses. The idea is to insulate them from short-term political pressure. And then you have the 12 regional Fed banks, too.
And their main job is monetary policy, right? Setting interest rates.
Basically, yes. Their key tool is targeting the federal funds rate.
Mm-hmm.
Although, interestingly, that rate itself is actually set by the market, by banks lending to each other overnight, the Fed influence of it. They also directly set the discount rate, which is the rate banks pay to borrow directly from the Fed. And those rates then ripple out, influencing the prime rate that banks charge customers. And that affects the whole economy. It's often quite a subtle influence, though.
Right. And Alan Greenspan, he was the Fed chair for ages, famous for his carefully chosen words. You mentioned irrational trepidation earlier. What was that about? Sounds like the opposite of his famous irrational exuberance.
Exactly. It was a direct parallel. He gave this really important speech at Berkeley in 1998, and he used that specific phrase, irrational trepidation. He was talking about times when the market would suddenly contract, pull back sharply. Greenspan believed, at that time, that the fundamentals were actually really strong. You had low interest rates, basically no inflation, consumers were spending. The economy looked solid.
But the market was acting scared anyway.
Precisely. He felt investors were being irrationally fearful, despite the strong underlying economic reality. It's fascinating, right? It suggests that even with all the data pointing one way, collective human emotion, fear, in this case, can just take over and push markets away from what the fundamentals say they should be doing, at least temporarily.
That's a huge point about sentiment driving things, but Greenspan had access to all this data, all this analysis. How could that kind of irrational fear take hold when the fundamentals looked good? What's that tell us about investor psychology, even now?
It tells us a lot, I think. It shows that fear can be incredibly contagious, can become almost a self-fulfilling prophecy, at least in the short run, even if the data doesn't support it. Froehlich saw this as a recurring theme, really. Sentiment can just overshadow the reality for a while until eventually, hopefully, the fundamentals win out. It's a good reminder for you listening, understanding market psychology can be just as vital as understanding the economic numbers themselves.
That is a great takeaway. And it sounds like the Fed's influence isn't just limited to the U.S., is it?
Oh, not at all. Froehlich really hammered this point home. When the Fed's committee, the FOMC, makes a decision on rates, it sends ripples absolutely everywhere. He pointed to a specific period, starting June 1999. Over the next 14 months, there were, get this, 125 central bank tightenings around the world. Basically, everyone else was following the Fed's lead.
Wow, 125.
Yeah. It really does function like a de facto global central bank in many ways. Shows you just how interconnected the whole global financial system is.
Incredible reach, a real global ripple effect. Okay, and then came the transition. Greenspan out, Ben Bernanke in. How was Bernanke's approach different? And how did Froehlich view that change?
Bernanke definitely had a different style. Froehlich actually nicknamed him Hurricane Ben back in 2006.
Hurricane Ben. Wow.
Well, partly because Bernanke was willing to do things differently. For instance, he was open to setting an explicit inflation target for the Fed, saying we aim for 2% inflation, for example. Greenspan had always resisted that, but other central banks, like the Bank of England, have been doing it since '92, arguing it increased transparency and predictability. But Froehlich was actually quite critical of Bernanke's early moves, specifically the interest rate hikes in 2006. He called them ill-advised.
Ill-advised. Why did he think that?
His reasoning was really interesting. He argued that high oil prices at the time were already doing the Fed's job for them. They were already slowing down the economy. He saw those high oil prices as basically acting like a massive $100 billion de facto energy tax cut, meaning it was taking $100 billion out of consumers' pockets, reducing their spending power. So the economy was already cooling. Inflationary pressures were likely easing naturally. He felt the Fed didn't need to step in so aggressively with rate hikes on top of that.
That's a fascinating perspective. External factors doing the work. So taking all this in the myths, the Fed's role, the psychology, what does this all mean for your investment strategy listening out there? Let's zoom in on some of those less obvious drivers.
Right. This is where Froehlich talked about differentiating between short-term blizzards and long-term icebergs.
Blizzards and icebergs. Okay, tell me more.
Blizzards are like the daily crises, the headlines, the noise, the stuff that grabs your attention right now, but honestly fades pretty quickly. An unexpected jobs report, a political spat, whatever. Icebergs, on the other hand, are the huge, slow-moving fundamental forces. Things like demographics, technology shifts, global free trade trends, maybe long-term government fiscal positions like budget surpluses or deficits. His argument was simple. If you focus too much on the blizzards, you get tossed around. If you focus on the icebergs, the big underlying trends, you get a much clearer, more stable picture for investing. It helps you navigate through those temporary storms.
That's a fantastic analogy. Really helps cut through the daily chaos. So what were some of those big, powerful, but maybe often unseen icebergs that Froehlich highlighted? What should you be paying attention to?
Well, one huge one he pointed to was the sheer power of cash, both corporate and individual, and also dividends. He noted that individual cash savings, just money sitting in savings accounts and money markets, more than doubled in a decade, from about $2.5 trillion to over $5 trillion by 2004. That's a massive pile of potential fuel just waiting to maybe enter the market.
A trillion, wow.
Yeah. And then on the corporate side, there's a big policy shift, the 2003 Jobs and Growth Tax Release Reconciliation Act. A key part of that was slashing the tax rate on dividends for individuals from as high as 38.6% down to just 15%.
That's a big cut.
Huge. And it totally changed the game for dividend-paying stocks. Suddenly, they became much more attractive to investors, and corporations responded. By 2005, nearly 400 companies in the S&P 500 were paying dividends, up significantly from 351 just 3 years earlier in 2002. It signaled this major shift where companies were focusing more on returning cash to shareholders.
That tax cut definitely sounds like it reshaped behavior. And didn't President Bush's 2003 plan get nicknamed something like, "It's the stock market, stupid"? What was the core idea there?
That's right. That was the nickname floating around. And the absolute cornerstone of that plan was eliminating the tax on dividends for individuals. That piece alone was estimated to cost around $364 billion over 10 years, more than half the entire plan's $674 billion price tag.
So it was really targeted at stocks.
Yeah. Oh, absolutely. The explicit goal was to boost investor confidence, try to get people back into the market after the dot-com bust, and also, importantly, shift corporate focus. Get companies thinking more about generating actual cash flow to pay those dividends, not just, accounting earnings. The plan had other bits too, like immediate rebates for the child care tax credit that was aimed at boosting retail spending right away.
Hmm.
And it quadrupled the amount small businesses could write off for equipment purchases, up from $25,000 to $100,000. That was mainly seen as a boost for the tech sector. So, yeah, multi-pronged, but the stock market and investor confidence were clearly central.
Sounds like it really aimed to rejig incentives across the board for companies and investors alike. Okay, beyond policy, how do you gauge real corporate confidence? Not just what CEOs say, but what they do.
Froehlich had a great phrase for this: leadership matters. He suggested watching what corporate insiders, executives, directors are doing with their own company stock, insider buying. Generally, it's seen as a bullish sign when insiders are buying a significant amount of stock, maybe more than half the amount they're selling. He noted periods where the selling rate jumped way higher than buying, and that was a potential red flag, signaling maybe insiders weren't so confident.
So follow the money, literally.
Kind of, yeah. He also pointed to another important sign of health: market leadership. He highlighted this shift in the S&P 500 around 2003. For a while, the market had been really dominated by just two sectors, infotech and telecom. Very narrow leadership. But by 2003, leadership had broadened out. It became more diversified across four sectors: healthcare, infotech, consumer discretionary, and consumer staples. That broadening out suggested a healthier, more robust market overall, not just relying on a couple of hot areas.
Right, a wider base of support, that makes sense. And we see merger and acquisition deals in the news all the time, but Froehlich argued it's more than just a headline, didn't he?
Absolutely. He talked about a massive M&A boom that was fundamentally reshaping entire industries, not just making news for a day. He gave some really powerful examples, like the telecom industry. Remember the breakup of the old Bell system, AT&T? Well, a wave of mega deals like SBC buying AT&T and Verizon buying MCI basically put it all back together again, just with different names. A complete reconsolidation.
Yeah, I remember that. It felt like everything changed.
Exactly. Or look at the oil industry, things like CNOOC's big bid for Unocal. These deals weren't just transactions, they were fundamentally changing the competitive landscape, creating new giants, altering power dynamics in sectors for potentially decades to come. It's long-term structural change happening, not just a fleeting news story.
That's such a good point about the long-term impact. Okay, let's broaden our view even more now. Let's transition fully to a global perspective. What really stands out when we look beyond U.S. borders? And why might your portfolio, listening now, be missing out?
Well, Froehlich had a really simple, powerful guiding philosophy here. Globalizing a good thing is usually good. Sounds obvious, maybe, but think about it. He frequently just stated the facts. The vast majority of the world's landmass, the vast majority of its people, its jobs, its economic activity, its natural resources, they are outside the United States.
Right. Obvious when you say it like that.
It is. And that simple fact just underscores why focusing only on domestic investments, while maybe it feels comfortable or familiar, inevitably means you're potentially missing out on huge opportunities for growth elsewhere in the world.
And he found some surprising opportunities, right? Places people had maybe given up on, like Japan.
Oh yeah, Japan was his Seabiscuit story. Remember the racehorse?
Yeah.
The underdog?
Yeah.
Well, Japan was seen as this investment long shot for years after their bubble burst. But then, Froehlich pointed out, it just boomed. It had incredible returns, 37% in 2003, then 12.5% in 2004, another 21.7% in 2005.
What drove that turnaround?
A couple of key things. One was really necessary, painful bank reform. Things like the bankruptcy of a major bank, Resona Holding, and big mergers like Mitsubishi Tokyo joining with UFJ, cleaning of the financial system. And the other huge factor, surging exports, particularly to China, which was booming itself. It was a perfect example of how internal reforms plus external demand can just unlock massive value, even in an economy that seems stuck for ages.
And China itself, obviously a huge story. He called that go for the gold. Right?
That's right. He painted this vivid picture of China's just immense, unprecedented economic explosion. A lot of it at that time was driven by the build-up to the 2008 Beijing Olympics. Think about the infrastructure needed: roads, stadiums, airports. That meant China was consuming just mind-boggling amounts of raw materials: cement, steel, coal. He also talked about the demographics, the rollerblade generation, he called them. Young people growing up in an era of sudden prosperity with totally different spending habits than their parents. A huge wave of consumerism.
So what were the key drivers, boiled down?
He summed it up with the acronym China TOP. T for trade, massive exports. O for oil, huge energy needs. P for people at demographic wave. And the second P for power, meaning electrical power. China's growth was so fast they were facing power shortages. They had plans back then to actually double their electric power capacity in just 5 years to keep up. Just incredible scale.
Incredible. And he also, he famously pushed back against how Wall Street traditionally thought about investing in Asia, didn't he? The whole Japan versus the rest of Asia thing.
Yes, absolutely. He really critiqued that standard Wall Street practice of creating investment products focused on Asia ex Japan, Asia excluding Japan.
Right, separating them out.
Yeah, Froehlich thought that was a huge mistake. He strongly advocated for what he called the big JC thesis, Japan and China together. His argument was that combining them gave you the best of both worlds. You got China's absolutely explosive growth potential, yes, but you also got Japan's mature, industrialized, stable economy, which could provide some downside protection if China's growth hit bumps.
So growth engine plus stability.
Exactly. He used this great analogy. He compared it to U.S. car buying habits. Back in the 70s, most Americans only bought American cars. Wall Street fund managers probably reflected that. Then came this huge generational shift towards Japanese and other foreign cars, and Wall Street totally missed it initially. He argued they were making a similar mistake with Asia. By artificially separating Japan and China, they were missing the bigger picture, this massive integrated economic story unfolding. They were missing the big JC.
That's a brilliant analogy. It really shows how easy it is to get stuck in old frameworks and miss a massive shift right in front of you. Okay, to kind of bring this all together, you mentioned he liked to tell a story about a pretzel thief. How does that tie into all this?
Ah, yes, the pretzel thief. It's one of his favorite stories, apparently, and it's meant to illustrate a simple but profound point about judgment and perspective. The story goes, basically, someone is sitting somewhere, maybe an airport lounge, eating pretzels. Someone else sits down, starts eating their pretzels. The first person gets annoyed, silently fumes, thinks the other person is rude, a thief. They share the bag begrudgingly. Then, when the other person leaves, the food person goes to get their newspaper and finds their own unopened bag of pretzels underneath it.
Oh no, they were eating the other person's pretzels all along.
Exactly. They made this instant superficial judgment based on incomplete information. Got it completely wrong, and only realized their mistake later when they saw the full picture. Froehlich used this story to directly connect to global investing. His message to you, the listener, was, don't be the pretzel thief. Don't make snap judgments about global opportunities based on limited information or preconceived notions. Don't assume the U.S. is the only place worth investing. Take the time to see the bigger picture so you don't look back later and realize how much opportunity you missed because you didn't take that truly global view.
Wow. That's a powerful story and a great way to end this deep dive. We've really uncovered some underlying strengths, overlooked opportunities across economies, across markets, things that definitely get obscured by the daily headlines.
Absolutely. I think it just underscores the incredible value of stepping back, adopting a broader, maybe more critical perspective. Don't just react to the immediate headlines or swallow the conventional wisdom whole. The real insights, the deeper understanding, as Froehlich consistently showed, it often lies just beneath that surface noise, waiting for you to dig a little deeper.
So maybe the final question for you listening is, what package of assumptions, what conventional wisdom might you be holding on to right now? What might be preventing you from seeing a world of opportunity maybe right under your nose?
Think about it. So many of these myths we discussed were widely believed, accepted truths for years. What could be today's equivalent? What common knowledge might be subtly limiting your perspective, not just financially, but maybe in other areas too? Always question, always look deeper. Be open to those interconnected forces at play.